Well, good Friday afternoon from the Jack and Bill show. Obviously, I just stole his line. Go for it.
Happy Friday to you. It has been an interesting week on Wall Street, Westley. Westley is sitting in for our friend and colleague, William, Wild Bill, who is traveling today. And he will most likely be with us next Friday. But the stock markets potentially in a little bit of in corrective mode for sure. Is this a correction or not? That's what I meant by potentially. We really don't ever know. But today, the markets, the S&P 500, haven't really seen this kind of volatility in a while, a few months, I think. S&P 500 was down 55 points today, Wesley, which isn't really a lot. It is when you're in a, calm, low vol market that keeps grinding higher, and then everyone looks up and says, "What happened?"
Yeah.
So
it's raining meatballs.
Yeah, exactly. So the S&P was down 1.3% today. Not a big deal, really, because the market is still on a total return basis after today up about 11.9% year to date, which would be a pretty good above average year in a normal whole year. Now, the Dow fell 533 points or a little bit more, call it almost 1.6%. NASDAQ market down about 0.9%. West Texas Intermediate up to 71.67. That's very close to, recent highs in the 72 range. Russell 2000 small cap stock index was down about 2.2%. And gold and silver really getting whacked this week. So, and we'll get into that. But so we thought we might just have Westley has some questions that we're going to kind of grind through, and just
not as quite as impressive as a newspaper.
Okay. What do you have for me, Wesley?
Well, let's just a general synopsis. What in the world is going on right now? I mean, you have a generation that's probably seen, inflation before. Well, I know they have, but then you have people that are, I'm close to 40, but so you probably have people a little bit younger than me that have never seen inflation, and they're probably going, "Why am I spending this much for, XYZ?"
Yeah, there's a Dallas, Texas hedge fund guru named Kyle Bass who profited immensely during the subprime crisis, and he came out and he said, basically, we're experiencing 10% inflation right now. Now the Fed numbers are more like 3% this year and projecting 2.5% next year. But I think they've made the CPI consumer price index. And remember, inflation, Wesley, is just a general rise in prices.
Right.
Okay, so but bad and inflation is one of the most insidious things that can invoke real harm and pain to people because, for example, you go to, I'm looking here at today's Wall Street Journal. The Dow Jones Commodity Index had been up about as much as 25% so far this year, and it fell about 3.5% yesterday. And or another one, the CRB index was down 6%. I'm sorry, down about 3% yesterday. Crude oil was down a buck 11 yesterday. Okay, nat gas actually was up a little bit, but gold fell 4.6%, and I think silver was down 7 or 8%. These have been deemed, safe havens. So what happened was is what got this all going. The Federal Open Market Committee, behind Federal Reserve Chairman Jerome Powell, they meet every 6 weeks, and usually they're Tuesday, Wednesday meetings, and they make an interest rate decision Wednesday mid-afternoon. Everyone knows what the interest rate decision is because with the pandemic, they pushed interest rates down to zero and said they weren't going to raise the Fed funds rate up at all until likely early 2024. So yesterday they came out because of concerns about inflation, which I think has mostly been brought on by poor fiscal stimulus policies to address the pandemic. For example, a lot of restaurant owners that we know in town aren't open even 5 days a week because they can't find help because they feel like they're competing with the federal government. They're being paid over $15 an hour to stay home.
Right.
And not all of them, make that much. So that's been the big brunt of the inflation this year is unit labor cost increases, and all those costs, wind up coming through to the consumer. But we've also got rampant commodity price inflation. That's why I picked this up. Crude oil is up 46.4% this year. And with today's rise, call it, 47%. 47%. So you feel that at the gas pump.
Right. Now let's circle back to something, because you use term, and I'm familiar with you using it because I hear it like every other day now. But not everyone's going to understand what is the subprime crisis. I know what you're talking about, but because we've talked about that and how that also could come into effect in the long run of everything we're experiencing right now too.
Yeah, well, we had the subprime crisis, which came about.
What is the subprime crisis? That's what I want to.
Right. In 08, 09, the last time the stock market fell more than 50% or lost half of its value, came about because I think what it was subprime means prime is high quality loans. Subprime is less than prime or less than high quality. And there's a really fascinating, it's an R-rated movie called The Big Short, which is terrific about showing this whole thing. But, in Michael Lewis's book, The Big Short, there were strawberry farmers in Arizona that making $15,000 a year that had $750,000 homes.
Right.
Some of these people, multiple homes. So they had what they called ninja loans back there. Do you know what a ninja loan is?
I know what a ninja is.
A ninja, yes.
You're a ninja.
That's right. Ninja. No, let's see. NINJA. No income, no job. I forget what the A part is. No income or no job, and you could buy $1 million house.
Well, that doesn't sound very good.
So, and then we had all these mortgage-backed securities that were created. So a lot of these aggressive Wall Street firms, like Morgan Stanley, AIG, Goldman Sachs. AIG's a large insurer, but they were engaged in this in a big way. But anyway, all these mortgages were packaged together. It's like, well, yeah, I understand the guy makes $15,000 a year farming strawberries and owns $1 million house, but when you combine all these loans from all over the U.S. and put them into one package, basically real estate prices are regional, and never before in the history of the U.S. could you say that real estate prices fallen in dramatic fashion everywhere at the same time.
Right.
And that was kind of a premise that all these mortgage-backed subprime loan wrapped mortgage-backed securities was based upon. And all that you needed, I think, was 5, 6, 7, or 8% of the underlying loans within one of those mortgage-backed securities to stop paying, and the whole thing went to zero. So there were some people that saw this coming, and like Kyle Bass, who I just mentioned
Right.
earlier. So here's the thing. So we have probably haven't looked at the numbers lately, somewhere between 15 and 18 trillion of worldwide debt that actually you have to pay them to keep your money. In other words, negative interest rates.
Okay.
So the United States never got there, and it's at zero. But here's the whole thing that happened Wednesday. The markets were a little bit calm back and forth Wednesday, but when everyone went home and digested this whole thing, pardon the expression, all hell kind of broke loose Thursday morning. And we'll get into more of that. But that is basically the Fed came out and sped things up, Wesley, and they said it looks like we're going to have to probably start raising the Fed funds rate in late 2023. Now, it doesn't seem like a big deal. That's over 2 years away.
Right.
So why would the market be acting crazy, now? And there's conflicting signals from the different markets
now,
as well.
So would that, because people would say, I guess right now that we're in a bull market, would that, because of what's happening, is that the sign that we're going from a bull to a bear market, or is it just a correction?
Well, first of all, you have to be more definitive of what market you're referring to.
Okay.
Because we're in a bull market in the stock market.
Right.
But we've actually been in a bear market in the bond market. You could say the last 2 days, those two things reversed. Okay. So, but I think this is your point. There's an old cliche that says the trend is your friend until it ends. In other words, we're in a bull market, and a bull market doesn't come to an end until you have I'd say you could call it a correction is defined as 10% or more. Some people want to call it 5% or more. 10% corrections, I think, happen on average about every year and a half to 2 years. And then a 20% pullback would be termed a bear market or a down market. And we had the last bear market was last year in March and April. And actually it was the quickest bear market in history because everyone ultimately decided, though actually America's still kind of divided on this. I was about to say everyone decided that the sky's not falling and things got going again, but we've had massive fiscal stimulus, and a lot of people do think that the sky is still falling.
Right.
So, but I think this is what I would say to your bull market question, Wesley, is the bull market appears to still be intact. And I think this is what we're seeing is some corrective action.
Right.
And when you have people like you say, that young people that have never seen rampant inflation, they can get spooked by these unusual, pullbacks. Not so unusual, really.
Right. And I think it's, we talk about how as far as people aren't able to return to work, where you have different states that are at different places of that process. And that's
exactly right.
And so where, state over here who's still not fully open versus like Louisiana, I don't know when we actually closed. I mean, we kind of did, but we didn't. And so but that affects everyone at the same time, even though you have these different states. And so you could see where, position A over here is affecting position C, even though position B hasn't changed.
Yeah, I think one of the things that's going to be very impactful in the coming weeks is unemployment benefits are set to end in about 22 states.
The mortgage holding as well, or rent holding, where people weren't having to pay rent because they couldn't. So
yeah, I think in some ways this is going to be good. You're going to see people coming back to work, but then you're going to see some people that aren't making their mortgage payments
in big trouble.
in big trouble. And yeah, so it's interesting, Wesley. I could throw this out there. What kept this big decline yesterday in in commodity prices, and what the market is really saying is yesterday, okay, we've been in a commodity bull market this year. You know, commodity prices up 20% or more. Think energy. So now it's like the Federal Reserve has a meeting and says, hey, we're going to start addressing this thing in 2 years. So here comes the Fed to the rescue party.
Right.
And so commodities, sell off sharply, and interest rates decline. Bond prices go up with lower rates. And just going to tell you how I feel about this, Wesley, to our viewers.
I think you should.
Okay, thank you. There's very little opportunity in the high quality, think U.S. Treasuries or Barclays Ag. Barclays Ag is still down something like 1.5% year to date. I think that's something that continues. I think that this is short term, and inflation is going to continue. I think it is going to be in waves, but I don't. Everything kind of seems wrong and upside down here the last 2 days.
Yeah.
Okay. I don't think this continues.
Well, it's on the terms of inflation. Like, saw a discussion with somebody in the farming industry, and they're basically explaining how their cost of a pallet went from like $14 a pallet, and they're like, normally we would just absorb that.
Yeah.
Well, now it's $60, $70 a pallet, but now to wrap that and secure that pallet, now the wrapping's costing more. Now this is costing more, and it gets to a point where the farmer's not just absorbing the cost anymore and saying, "Well, that's just part of my cost of doing business." Now they're having to pass it along to the buyer, and that's where I think people are starting to, they're starting to see that effect on things, like in grocery shopping, and it adds up little by little every day.
Yeah, I think you could call that in some cases stagflation. It's when you've got an economy that's somewhat stagnant, and then you have this cost push, commodity and labor costs increasing, pushing prices up. Usually when things are inflating, there's too much money chasing too few goods, and the economy's fine. Well, I mean, we're not really having stagflation right now, though, because with all of the Fed and fiscal stimulus, I think we have a very robust year in front of us in terms of economic growth.
Okay.
GDP growth this year should be 6 or 7%.
Okay. So what do you think with this, kind of considering all things and what's been going on in the last few days? What's the direction? I guess you would say that in the market you're going to go from here forward. Up, down?
I think there's going to be. It's interesting because today I thought we might see a rebound in the market, and then Federal Reserve. Let's see, St. Louis Federal Reserve President James Bullard likes to vocalize things a lot. He came out and said that we're likely going to see the Fed start tightening next year. He said inflation is here. He doesn't think it's so transitory. So he's disagreeing with the consensus of the FOMC narrative from Wednesday. And he's saying we're probably going to be tightening next year. And now, another thing for our viewers, you've heard us talk about quantitative easing. Okay. Do you know what quantitative easing is, Wesley?
No.
Yeah, you do. Okay. Okay. So what one of the tools in the toolbox that the Federal Reserve has been using has been to purchase to the tune of $80 billion a month U.S. Treasuries and pull them out of circulation from people that own these treasuries and, hold them on their balance sheet. The Federal Reserve is historically not supposed to have a balance sheet. So they're buying $80 billion a month of U.S. Treasuries and $40 billion a month of mortgage-backed securities. So call it $120 billion a month. That's called quantitative easing. So they're easing monetary conditions by purchasing bonds, treasuries, and mortgages, and making rates go lower and bond prices go up. And this could be creating another mortgage bubble. We've got housing prices going crazy, a lot of speculation going on. All the flippers are out again, trying to make a quick buck because they've got really easy money, easy financing doing this thing. But James Bullard came out today and said, okay, the stage is now set for all these FOMC meetings for all the different governors to start having a dialogue about stopping quantitative easing. And he thinks it should be eliminated. Now, the last time when we came out of the subprime crisis and Janet Yellen was our Federal Reserve chairman, and when you slow down the quantitative easing, they call that tapering.
Okay.
Well, when all they had to do was announce that it was coming, and we had a taper tantrum. So I'd be on the lookout for another taper tantrum. We could hear this as soon as 6 weeks from now with the next FOMC meeting.
So let's put a pen in taper tantrum because it sounds a lot like temper tantrum. When you say tapering, because I like to break things down out of popular terms and break it down so that it's easily understood. What do you mean by tapering? And because people, we realize what took place in 2008, 2009. You had a lot of people buying homes that probably shouldn't have had loans. Just because they economically couldn't be in a place to have a $500,000 home.
Faux show.
Thank you. Oh, Lord, help me. Jesus, take the wheel. Yes, faux show. So you had a lot of people that had money buying a home, but they didn't have the ability to buy this type of home, the size of home that they were necessarily in. So then, therefore, they lost the home, then created a homeless issue. So, what does this look like today?
Well, what's going to happen with potentially, this is actually what
hypothetically.
Here's what I think will happen. Okay, so what tapering means is if they're doing quantitative easing or QE or a bond purchasing program of $120 billion a month right now, and they stop doing the mortgage-backed security tapering. Okay, so with a taper tantrum or tapering the purchases, stop doing the QE and start tapering. That means they go from 120 to something less than that.
Okay.
So they could announce that. I don't think they'd start immediately, but they could say okay, we're into June. They could meet at the next meeting and say, hey, September the 30th, we're going to wind back to $50 billion a month instead of 120.
So that causes interest rates to go up then.
Oh, yeah, that would cause interest rates to go up. And it actually could cause panic selling in the bond market, and the markets could determine the yields, more quickly than the Federal Reserve would anticipate or want to occur. So, but they'll likely do something like $10 or $20 billion a month until they get to zero. That would be, the tapering. Then the next step. So I think that's what happened. I think that's what Jerome Powell is thinking. Okay, we come up with a plan to taper until, I think Wednesday said September 23 is the most likely rate hike. So they come up with a taper plan from here to September of 23, where we go from 120. So if they did 5 billion a month, we get there 120 to 115 to 110. In 24 months, we'd be at zero. And then they say next step, raise the Fed funds rate. Okay.
Okay. All right.
Now we did start to see this when the market gets in the fear mode, though, get out of the way. So we did have the Minneapolis Fed president, Neil Kashkari, and he's another one that likes to voice his views. He said he wants to keep the Fed funds rate at zero until 2024 to allow the labor markets to continue their advancements and to get back to 5% unemployment is considered full employment, but we got down to like 3.5% under Trump.
Right.
So we're pretty close to 6 right now. Okay, just a shade under that.
So in this, with things kind of having a roller coaster right now, as long as we don't end up in a loop, what about kind of the buying on the dips and like riding this out and kind of what are your...
No, that's a good point, because first off, I could be completely wrong. I mean, most of the things I've shared with you are factual, about what the Fed is doing and so forth, but anything that we give, that's directional is just our opinion, and we could be wrong about that. But I think it's interesting, Wesley. I just thought of the word contrarian. And I think with the way this trade is going right now, if you go with the flow or the herd mentality here on this last 2 days of bear stock market type thinking, bull bond market type thinking, I don't think you make any money with it, and I think you ultimately lose money. So the contrarian play is to do the opposite of what's happening right now, and to make money at it, though, you have to be right. But that's where the money is now, because as you said, the bull market is still a bull market. Easy money is still easy money until interest rates go up. Here, interest rates have come back down the last few days, sharply, you could say. We got up to around 2.5% on the 30-year U.S. Treasury bond yield, and we're flirting with going below 2% again. So mortgage rates are going lower, as well. I mean, the money to be made is on the other side of that trade. I think having commodity exposure, staying away from the high quality bond market. I'd say short-term, lower tier, high quality investment grade bond market. There's an interesting article in today's Wall Street Journal about huge issuance by corporations of variable rate debt. And one of the big ones coming to market right now is issued by Verizon. That kind of stuff is a whole lot more appealing to me than owning long-dated U.S. Treasury securities and mortgage-backed securities. Yeah.
So putting all of this whole conversation today into the philosophy of Eagle Financial, of maximizing returns and minimizing risk, what would be your parting words of wisdom, your fortune cookie of advice to those watching?
Well, you can't maximize returns and minimize risks all at the same time. I mean, like you can target a return and minimize risk for that return. So I would just say, generally speaking, we target reasonable returns without undue risk, given whatever somebody's objectives are, what the money's for, liquidity needs, risk tolerance, return expectations, income needs, time horizons, things like that.
Right.
So what's the question again? What do we do?
So basically, in summation of what we've been talking about, how do we come into the words of wisdom that would kind of lead us to the reasonable return without undue risk?
Yeah, I would say in this market right here, don't get spooked. Because we've said our clients have participated in this pullback because we've got pretty good commodity exposure, but it has served us very well so far this year. So you don't want to get spooked out of this market, watch it go back up 10%, and then decide it's time to get back in, because you will have missed that.
Right.
So we want to stick with what we've got, monitor, watch, evaluate what's going on. Shakeouts like this great shaking that's going on creates opportunities, gives us an opportunity to buy things on sale, and we're doing that. And as long as this bull market is intact, which it is, and we're going to continue to own the things that have gotten us where we are. Where the bond market, high quality bond market's down 1.5% so far this year. Our bond positions have probably made 4 or 5% in aggregate. We want to continue to own those things, hold on to them. We want to continue to have commodity exposure. We want to continue to own things like safe havens like gold and silver, which have been whacked, that I think are going to do much better than the bond market. Those are currencies. We have a 1% to 2% weighting in cryptos, which I think makes a lot of sense in here. Notice that MicroStrategy was up most of the day.
Yeah.
With the cryptos down a little bit. And we like that which is scarce, which is income. We like along that same vein is deeply discounted closed-end funds. So you buy these at a large discount, double digits, typically, to what the underlying assets are worth, and they pay above market dividend yields.
Okay.
Yeah. So we like value stocks over growth. We think cyclicals. I'd much rather own GM or Ford than Tesla.
Right.
Why pay 200 times earnings for something when you can buy GM or Ford at 8 times earnings? And I think they know how to make electric vehicles just like Elon Musk does.
Right.
So we like reasonably priced. We like industrials more than we like the S&P, more than we like the NASDAQ markets, but we like select names in the NASDAQ market that sell at more reasonable valuations. And you do get, one of the things you get with technology in the NASDAQ market is that you'll have some companies that have high growth no matter what the economic conditions are.
Gotcha.
Yeah.
Okay. So now to Jack Dit with sports.
It is an interesting. We've got one of the 4 majors in golf going on. Second round today, Westley. So they determined there's a gentleman named from Switzerland. I don't know this guy, but the U.S. Open is.
You haven't met him?
Have not met him.
Oh, okay. I'll introduce you.
I have met some pro golfers and some pro golfers from Shreveport, and we have a friend that played pro golf.
This is true.
I played with him yesterday, actually.
I heard.
Yeah. So U.S. Open is going on in San Diego. Now, you're familiar. Do you know anything about Torrey Pines?
Very familiar with Torrey Pines.
Oh, you are?
Yeah, I've gotten lost there a number of times.
You have? Okay.
Yeah.
Okay. You tripped over a golf ball.
Yeah, something like that.
This is Phil Mickelson's.
Beautiful hiking in Torrey Pines.
That's what I hear. Phil Mickelson's backyard. He's going for the career Grand Slam. Just turned 51. And I think maybe this week. He just won the PGA a few weeks ago. Oldest guy ever to win a major at 50. He is +4 the last I looked today, which I'm not exactly sure what the cut is, but that doesn't look very good. So there's like 150, 160 golfers there. Russell Henley, U.S. golfer, near the lead at Richard Bland's, the Swiss golfer, at -5. Bubba Watson made a late run to close at -3. Brooks Koepka and Xander Schauffele are right in the hunt there too.
So here's my question. If 150 to 160 golfers are all golf clapping, is that loud?
Well, it gets loud out there when you've got everybody following them around. I can tell you that.
Oh, I'm sure.
Okay, and my favorite sport,
women's soccer. Women's soccer is Jack's favorite sport.
Yes. No. Last Friday after the Jack and Bill show, the LSU Tigers men's track and field team took to the track at Eugene, Oregon, and won the men's national championship. They are national champions, and they scored 83 points to, I think, Oregon. Home field, Oregon Ducks scored 51, something like that. Huge margin of victory. Well, the LSU Tigers are back at Oregon once again for the U.S. Olympic trials. You know, Westley, the Olympics are slated to start, I think, the last day of July and go into August, you know, for 2 or 3 weeks in Tokyo. And I'm not sure, I don't think anybody is still certain that we're going to do this thing or not.
Maybe they could all like Zoom run.
Zoom run. Yes, we can do Zoom meeting competitions.
Look at him shot put. Move the camera.
But the Olympics, I hope that we have the Olympics. It's one of my favorite things to watch every 4 years. And Winter Olympics every 2 years. But track and field is a huge stage of the Olympics. And I think there's actually something like, in 2016, there were 307 medals given out, 307 golds, 307 silvers, and the same bronze medal. So there's 307 different events forthcoming. But, you know, track and field comprises almost 10% of that. And so Eugene, Oregon just completed this $280 million facility. Phil Knight, the founder of Nike, gave them $2 billion. And I wish that I were out there watching this thing, but I think over the next 8 days, in fact, track and field gets going at 6 p.m. Pacific time today. And there are 30 LSU athletes, 18 present athletes, and 12 former athletes. And some of those guys and gals are going to make the team. So I kind of have a dog in the hunt, at least in terms of interest in spectating.
Right. Okay. Any other sports going on, Jack? Like Quidditch or something?
Well, there is another.
Oh Lord, I was not prepared for this.
We've got 3 SEC teams beginning play with the College World Series kicking off.
Okay.
So Omaha, Nebraska's cranked up again. It's been whittled down to the top 8. LSU's Paul Maneri, head baseball coach, stepped down after, I think, 21 seasons and 1,500 wins. He's a sure thing for the College Baseball Hall of Fame. And LSU is looking for the talk is this Bianchi guy that played at LSU, coached at LSU, and he's the head coach at Ole Miss right now, with his son playing baseball for the LSU Tigers. I think he may be the local. I think he may be the high probability favorite, to get that job. Unfortunately, he did get knocked out of the Super Regional, and Ole Miss is not playing in the College World Series. He made it to the final 16, but not the final 8. So that's about it.
That
Wesley.
is about it. That's all, folks.
So we'll just say stay the course. If you have any questions, give us a phone call.
Or you can message us directly on Facebook. We do check those. We do respond to them. You can also leave a comment if you're watching. That always is cool. Say hi when you're watching. Don't just be a watcher. Be a participant. Anything else? Any parting words?
That's good, man. Okay. Happy Friday.
Yeah,
we'll see you
Friday.
next week.
Make good decisions.